can you use roommate income to qualify for a VA home loan? That's the question we're going to go over today, and I'm going to give you guys some tips and different things that you need to understand when you're considering buying a property and what goes into it. So this question actually comes from a subscriber that reached out that had the idea of like, look, I want to buy a single family home. There's a website that, shows rentals, can tell you, hey, pretty much what the rental income is going to be on the individual unit that you're going to be renting out. And can I use that to qualify for my VA home loan? So the short answer to that is you cannot do that, but I'm going to show you ways that could factor in and the type of properties you can buy that will allow you to use rental income to qualify for a purchase. Now, we've done videos in the past talking about purchasing investment properties, in air quotes, with the VA loan as long as you occupy that property first. You could always turn it into an investment property. Now, thinking about for the future, right, depending on where you buy, it's going to depend on the, desirability for, let's say, Airbnb or there's all different types of websites that do those. Do you want to do short-term rentals? Do you want to do midterm or long-term rentals, right? So when we say long-term rentals, we're talking a year plus. That's the traditional way that someone goes into purchasing a property and considering that. Now, for all the entrepreneurs out there, you're thinking, well, hey, how do I maximize my monthly income, which might be the Airbnb route, but again, depends on where you live. In some areas, you may really have high Airbnb rentals, in others you don't, and then you also have seasonality as well. So let me show you guys the website that was shared with me. So this is just so we have a point of reference. I'm not sponsored by these guys or anything like that. So this place is called PadSplit.com, right? So this is the website he told me about and said, look, hey, there's places for rent, and this is basically how I'm coming up with this. So if I click on Dallas, let's say, it's going to pull up all the different properties that are for rent and basically how much you can get. Now, some of these range, I know you can't see the whole thing, so kind of exit out of there. So it's ranging from like, 170 bucks a week to, what am I seeing really quick? 360 a week for having somebody rent a space, like a co-living space from you, right? So essentially, I feel like that's just an Airbnb. But they also have places like for roommates that you can look for that can at least help you gauge if you want to, maximize your budget. Like, do you want to rent a room? That may help offset your debt, but you still have to qualify for the full mortgage if you're buying a single family home. This is something that you can keep in the back of your pocket to say, look, if my mortgage payment's going to be $2,500 and, I was really looking for a 2-bedroom, 2-bath, but 3-bedroom, 2-bath might make more sense from a resale perspective. This is why we're always saying that when you're going in to buy a home, know your exit strategy, right? If you buy a 1-bedroom, 1-bath home, that's going to be much harder to move than something that has more 3 or 4 bedrooms and then 2, 3 bathrooms, okay? And then depending on the area, if there's a basement or not, this is why it's very hyper local to this area that you want to buy, because you want to see what sells the fastest in your area. That gives you that good breakdown. So this just helps you with your monthly budget component, right? Because if you're like, well, if I can make an extra $1,000 or $1,500 by renting a room or two, or renting out, converting the basement potentially to a ADU, right, additional dwelling unit, that can add to your overall bottom line. Now, let's shift gears and talk about when can you use rental income to actually help you qualify for a VA home loan. Now, that's going to be on a multi-family property. So with the VA home loan, you could purchase up to a 2 to 4 unit building. And in some cases, you can also purchase 3 units with 1 commercial space. Now I have a whole video dedicated to that, so please make sure you check out the channel. And by the way, my name is David PITI. I am a loan officer. So if you're interested in using a VA loan, I can help you with that process. So when it comes to multifamily, you have the opportunity to purchase a 2 to 4 unit building and use the rental income to help offset the payments so you can qualify for more. Now, the criteria around that is twofold. One, you need to have at least 6 months of reserves. That's the principal, interest, tax, and insurance of the payment in your bank account. Now, it doesn't have to be liquid. You can use a retirement account as long as you can liquidate it. So the lender will typically require you to submit your 401k or whatever you have TSP account, and then also the liquidation documents for it. You don't have to liquidate it, but just showing that you can liquidate it, because there are some accounts that you can't liquidate. So we see this sometimes with unions and different things like that. So you have to be careful. The second part within that is that when it comes to, let's say, using like a 401k or some kind of stock account, lenders may use either the whole piece to say, hey, 100% of this we can use, or they're going to go more of a conservative route and say, well, we're only going to use 60% of that value. So that can throw a wrench into the mix. And with reserves, you cannot use gift funds for reserves. They have to be seasoned assets, meaning that you've had them in your checking account for 2 billing cycles, right? That's really important to understand that. Because like if you're trying to close all of a sudden on the house and you're like, oh, I'm $5,000 short for my reserves, then, you want to be able to either save that money up over time, or if someone does give you a gift, they could basically offset your monthly living expenses, and then you take your checks and then you keep those to then season the money. So that is a trick that you can use if you're in that position. We typically don't see that too much, but it happens sometimes because you might be slightly short. So it's a quick fix to the problem. The other part with that is that you have to also hire a property management company if you don't have 2 years of property management experience. And let me explain that in a little bit detail, because people will be like, oh yeah, I have experience. I'm a realtor, or hey, I've helped other people rent properties. That's not what they're talking about. You have to show that you have owned a property, that you have rented out, and you need to do that for 2 years. This is the problem when you do that. That experience then you don't have to hire a property manager, but then that means you have to show your taxes. And I'll tell you, doing this for a long time, helping thousands of people out, most people will have it so that they actually have negative income from their rentals, meaning that we can't even use their tax returns to qualify them, because if we did, it would actually be a negative income coming into them. So if you have positive W-2 income and then you have negative income from like, let's say, your rentals, we now have to subtract that negative income from your income to qualify you for less. So that's something you want to think about when you're going through this process. And like for us, we'll review it all and then we'll make the recommendation as needed. But you definitely need to check your taxes, because people are like, oh yeah, I rent it for $3,000 a month. And then we look at the taxes, like, yes, you do, but all this all these expenses, everything, you make actually negative $500 a month according to your taxes. So that's why it's so important to understand how your taxes factor into your home buying journey, and especially before tax season. If you guys want to reach out, we can review the preliminary taxes you have and see what's going to work, what's not going to work. Now let's go to the property management piece. Now for the property management piece, you just need to hire somebody to be able to either do a full service for you, like, hey, I want nothing to, I want to do nothing. I want someone else to do all of it for me. You can do that. And we've also seen veterans pick a la carte options. So that's an important option, because let's say you're like, hey, I'm going to rent the property out myself, but I travel a lot, so I just want to have maybe somebody help me with the handyman component of it. You can have a property manager company just do that. Or if you're like, hey, I'm good with managing the tenants, I just need to find tenants, they'll help you find them. And then in other times, people are like, well, I can pretty much do all of it myself, and then I'll just hire independent handyman or whatever, someone to help you around the house when you're not around. Or if you're moving out of state, that's just another option for you to have, okay? Now, the way that lenders are going to look at the proposed rental income to qualify for you is going to be twofold. It's either going to be if there's tenants in the property, they may say, hey, let's look at the rent rolls. Or they're going to say, what's the average market rent? And that's the appraiser is going to determine that. Pros and cons to each one. Most of the, it's just, it varies because some places, right, may have tenants there for a long time and they didn't adjust the rent to market rent to where it is today. And now you're coming in going, well, rent's 2,000 a month, but they're only paying 1,200 a month. What am I going to do here? And it's going to throw your numbers off. The other part is sometimes you may have somebody that's, let's say in that same example, is 2,000 a month, but they're paying 2,500 because it's, let's say, a brand new property or fully rehabbed and it has all the amenities somebody would want. And so you're gaining a higher premium, or you got lucky and you had a corporate reload contract for 2 years and then it's going to adjust afterwards. Now, that's all from an overall investment perspective. You need to think about that. Now, that's how the lender's going to qualify you, right? And they're going to also use 75% of that market rent. Okay, so that's another part, right? So if you're collecting 1,000, lender's only looking at $750. 25% of that is a vacancy rate, right? So that would mean that, hey, out of the 12 months, a quarter of that, your unit's going to be vacant. That's kind of like a safety net. And then also having the 6 months of reserves, right? Just in case you don't have a tenant, then you have somebody that you can put in there. Another part that you're going to be thinking about during this, hey, I have a multifamily, again, if it's in a desirable area, also factoring things like, well, if I do one of these week-long rentals, if I do Airbnb, or if I do a roommate situation, what would that bring in? I recently talked with a veteran that reached out, and they had a multifamily property, but in order to maximize income, they just didn't rent the first floor out to let's just say a single person. What they did is they did the co-living space. So they had 3 people in 3 separate bedrooms, signed separate leases, so they could generate more income off that unit than they could if they were renting it as an individual unit for a year-long lease. So those are things that you want to consider while you're going through this journey. Thank you for watching. Make sure you guys hit the like and subscribe button, and I'll catch you guys on the next video.